Hi everybody. This video is still about this sample question. Remember this sample question? Okay. So these are the business transactions. You have seen these transactions before, and then these are the questions. Okay, so the first question is you have to analyze the business transaction. You have seen how to do this question, and then also we have discussed about this question about how to record the transaction in general journal. Okay, now we will do the C question, which is to post the journal entries to the ledger. The question asks you to post the journal entries to the ledger. So this is also the third step in the accounting cycle. Okay, let's see how to do this. Okay, to answer the C question, you have to refer to the second step of the accounting cycle. This is the second step of the accounting cycle. In the second step of the accounting cycle, you have recorded all the transactions in general journal. Now the question asks you post the journal entries to the ledger. Okay, so first you have to know what is a ledger. A ledger is the second book that you will use in the accounting process. Remember, the first step in the accounting process is to do the analysis, and then the second step is to record the business transactions in the journal. The third step, or the third things to do in the accounting process is to transfer all the journal entries into the ledger. So ledger is the second book that you will use in accounting. Ledger is like a book. In the book, there are many T accounts. Okay, the question asks you to transfer all the journal entries into the T accounts. So how to do or to answer this question? So let's see. It is very straightforward. So okay, so now see. Okay, see here. Okay, your journal entry is debit cash 5,000, credit capital 5,000. Okay, how to transfer this journal entry into the ledger? Okay, or how to transfer these journal entries into the accounts into the accounts in the ledger. So ledger is like a book, and then in the ledger there are many T accounts. So you have to create the accounts, the T accounts. Okay, it is like this. You will use many T accounts. Okay, let's see. So here, how to answer the question C? You check the first journal entry. So in the journal entry, you record 1st of January, debit cash 5,000, credit capital 5,000. So when you see this, debit cash 5,000, you open the cash account. You open a cash account. So this is the account. The account is in the T format. It is like a T. Okay, T. So you give the account a name. So this account is a cash account. So this, remember, debit means record in the left, credit means record in the right. So here, 1st of January, the journal entry is debit account cash 5,000. So in the ledger, how to record that? This is account cash, this is the debit side. So account cash, 1st of January, the date is 1st of January, debit account cash 5,000. So see, 1st of January, debit account cash 5,000. So in the ledger, you do like this. Debit account cash, debit means record in the left side of the account. Debit account cash 5,000 at the 1st of January. Okay, debit account cash 5,000 refer to account capital. You write here capital. Why you should write capital here? Because this is account cash, and then this is the debit entry or debit record. So you know that debit account cash 5,000. Why your business or this business debit cash 5,000? Because of an increase in capital. So this is done. So you can tick this entry. You have done this. And the second thing in the journal is credit account capital 5,000. So when you see credit account capital 5,000, you have to create an account for capital. So it is a T account. You give the account a name. The name is account capital. So see here, credit account capital 5,000. So this is account capital. This is the credit side. You write the date, 1st of January, credit account capital 5,000. Refer to account cash. Here, capital, you credit 5,000. Why you credit capital 5,000? Because of there is an increase in cash. Cash debit 5,000. Why you debit cash 5,000? Because there is an increase in capital. So in the account capital, you write credit account capital refer to account cash. Okay, so you have done the first the journal entries on the 1st of January. Okay, that's it. What is the next thing? So when you want to prepare the ledger, you only have to refer to the journal. You don't have to refer to the business transaction. So it means that when you do the step 3 in the accounting cycle, you have to refer to the step 2. You don't have to refer to the step 1 for the transaction. Okay, now the second thing that happened is debit equipment 3,500, credit account capital 3,500. So debit equipment 3,500. How to transfer this to the ledger? So you have to create an account for the equipment. So you create a T account for the equipment. Okay, so debit 3,500 equipment. So this is debit 1st of January, debit equipment 3,500. Refer to which account? Debit equipment credit capital. So refer to account capital. You write here capital. And then okay, so you have done this. And then the next thing is in the general journal, the second thing is credit account capital 3,500. So you check your ledger. So you already have the account capital, so you don't have to create a new one. So credit account capital 3,500. The date is Still 1st of January. So 1st of January, the second thing that is happened is you credit account capital 3,500. Okay, credit account capital 3,500. Refer to which account? Refer to the equipment account. So credit capital 3,500, refer to account equipment. See here, the date is 1st of January. Debit equipment 3,500, refer to account capital. Credit account capital 3,500, refer to account equipment. Okay, now we have to do the next transaction, the next journal entries. Okay, the next journal entries are this. Okay, 2nd of January, debit account equipment 2,300. So you know that you have to transfer this into the equipment account. So do we have equipment account? Okay, we already have the equipment account. So the next thing is debit account equipment 2,300. Okay, so you write in the account equipment 2nd of January, debit 2,300. Refer to what account? Equipment debit 2,300, refer to cash account. So you write here cash. Refer to account cash. Okay, so this is done. The next thing is credit account cash 2,300. So we already have the account cash. So we have to credit the cash account 2,300. So the date is 2nd of January. Credit account cash 2,300. Refer to account equipment. Okay, this is done. Okay, then you do the next thing. The next thing that is happened on the 2nd of January is debit rent expense 500. So do we have rent expense account? No. So we create a new account. So the name of the account is rent expense. Okay. So the entry is debit rent expense 500. So the date is 2nd of January. Debit account rent expense, the amount is 500. Refer to account cash. You write here cash. Okay. And then this is done. And then for account cash, so and then the second entry is credit account cash 500. So this is account cash. You have to credit the account cash. 2nd of January, credit account cash 500. The refer to account rent expense. Okay, this is done. Okay, now do the next entry. Okay, the next thing is on the 3rd of January, debit supplies 350. Do we have a supplies account or account for supplies? No, we only have cash account, capital account, equipment account, and rent expense. So now you have to debit supplies account. So you create an account for supplies. So this is an account for supplies. Okay, so the entry is debit supplies 350. So this is the account supplies. 3rd of January, account supplies debit 350. Refer to what account? Refer to account payable. So you write here account payable. Okay, account payable. And then the second entry on the 3rd of January is you have to credit account payable 350. So there is no account payable yet. So you create a new account. An account for the account payable. So this is account payable. Okay. So the entry is credit account payable 350. So this is the account payable. The date is 3rd of January. Credit 350. Refer to which account? Refer to account supplies. So you write supplies here. Okay, this is done. Now you do the next thing. Okay, the next thing is 10th of January, debit cash 750. So this is the cash account. We already have the cash account. Debit 750. The date is 10th of January. So this is debit side. So you write the debit side. 10th of January, debit 750. Refer to which account? Refer to account revenue. So you write here revenue. Now, do we have account revenue? No, not yet. We don't have the account revenue yet. So, you have to create an account for revenue. So, let's say we create an account for revenue here. Sometime, so the account for revenue. Okay, so now you have to, this one has been recorded in cash account. So you have to transfer this journal entry into the ledger. This credit revenue is 750. So this is account revenue. You have to credit the account. The date is 10th of January. The amount is 750. Refer to account cash. See, refer to account cash. Okay, that is done. Do we have the next thing? Okay. We have the next thing. The next thing is on the 17th of January, debit cash 900, credit revenue 900. So this is account cash. You have to debit 900. So the date is 17. The amount is 900. Refer to account revenue. And then, so this is done. This is done. And the next thing on the 17th of January is you have to credit revenue 900. Okay, we have the account revenue. So the date is 17th of January. You have to credit 900. Refer to which account? Refer to account cash. Credit revenue, refer to account cash. So you have to write here cash. Okay, so this is done. Okay, now we have to do this to all the journal entries. So now the journal entries on the 24th of January. 24th of January, debit cash 870. So this is account cash. 24th of January, you have to debit 870. Refer to account. Refer to which account? Refer to account revenue. These two accounts goes together. You debit cash, refer to account revenue. You credit revenue, refer to account cash. So you have recorded here debit cash 870. Refer to account revenue. Okay, now, okay, you have done this. The second thing is revenue, credit revenue 870. So this is account revenue. The date is 24th of January. Credit account revenue 870. 870. Refer to account cash. See, refer to account cash. So this is done. The next thing is debit account receivable 70. Okay, we don't have account receivable yet, so we create a new account, an account for account receivable. So we create a new account receivable. Okay, so here debit account receivable 70. Account receivable is here. The date is 24th of January. 24th of January. Debit 70. Refer to which account? Refer to account revenue. So account receivable debit 70. Refer to account revenue. Okay, you have done this. Account receivable debit 70. And then the next thing is credit account revenue 70. So account revenue is here. You have to credit the account. The date is 24th also. You have to credit the account 70. Refer to which account? Refer to account receivable. So refer to account receivable. You write the account receivable. Okay, so you have done this. So do the same thing to the transaction on 28th of January. 28th of January, debit utilities expense. Okay, debit utilities expense 275. We still don't. We do not have the utilities expense account yet. So you create a new account. You create a new account for the utilities expense. Okay, so you have to debit that 275. Debit 275, 28th of January. Debit 275. Refer to which account? Refer to account cash. So here utilities expense debit. Refer to account cash. Now that you have done this, the next thing is credit cash 275. So we already have the account cash. So now you have to record credit cash on the 28th of January. You have to credit cash 275. Refer to account utilities expense 275. Okay, here utilities expense 275. Okay, now do the next thing. Okay, this is the next journal entry. 29th of January, debit account payable 200. So do we have account payable? I think we have the account payable. We already have this one. So the date is 29. You have to debit 200. So account payable, you have to debit 200. So you have to debit 200. The date is 29 of January. Refer to which account? Refer to account cash. They goes together. So refer to account cash. Now, so you have done this. The next thing is credit account cash 200. So we have the account cash. The account cash is here. Credit 200. So the date is 29 of January. Credit 200. Refer to account payable. So you write here account payable. So this is done. Okay, what is the next thing? Okay, on the 30th of January, there is another transaction. You have recorded this transaction in the general journal. So 30th of January, debit cash 50. So we have account cash here. So very easy, very straightforward. Debit cash 50. 30th of January, debit cash 50. Refer to which account? Refer to account receivable. So you write here account receivable. 50. Okay, done. So you tick this entry. You have to tick the entry so that you know you do not miss anything. You have to transfer all the journal entries into the ledger. Okay, the next thing is credit account receivable 50. So we have account receivable here. The date is 30th of January. You have to credit account receivable 50. Refer to which account? Refer to account cash. So you write here cash. Refer to account cash. Okay, now we do the next thing. Next thing is the transaction on the 31st of January. There are two transactions on the 31st of January. First, debit cash 700 and credit revenue 700. So you know we have account cash. So debit cash 31st of January. Debit cash, the amount is 700. Refer to account revenue. Okay, refer to account revenue. They goes together. So this one is done. And then credit account revenue 700. Refer to account cash. Credit revenue 700. So account revenue, we have account revenue here. So 31st of January, we credit account revenue 700. Refer to account cash. So the next thing is debit drawing 600. So we don't have the drawing account yet. So you create a T account for the drawing. Okay, this is account drawing. The transaction says that you debit account drawing 600. So drawing 31st of December. Debit drawing 600. Refer to which account? Refer to account cash. Refer to account cash. And then, okay, this is done. This entry has been transferred to the ledger. Now you transfer this entry into the ledger. Credit cash 600. So you see we have account cash. So you have to credit account cash 600. So the amount is 600 you credit. The date is 31st of January. The transaction refers to account. Refers to account drawing. Okay. So you have transferred all the journal entries into the ledger. Okay, when you have transferred all the journal entries into the ledger, this is the ledger, means that you have answered the question. Okay, you have answered the question C. Before that, the next thing to do after you have transferred all the journal entries into the ledger, the next thing is you have to calculate the balance for the balance of every account in the ledger. Okay, so you have to calculate the balance at the end of the month or at the end of the year. So in this question, the transactions are for the month of January. So it means that you have to calculate the balances for all accounts in the ledger on the 31st of December. The 31st of January. On the 31st of January. Okay, the question is how to calculate the balance for each account. Okay, the process is straightforward. The way to do it is like this. Okay, see here how to calculate ending balance. An ending balance for an account. So here we do the account cash first. How to calculate the ending balance for account cash? So the thing that you have to do is you have to do like this. Okay, the thing that you have to do is first you have to calculate the total of the amounts in the debit side and also in the credit side. So now you add all these numbers, 5,000 plus 750 plus 900 plus 870 plus 50 plus 700. If you calculate these numbers, the total is for this side is 8270. 8270. Okay, 8270. And then this at the same time you have to calculate the total of the amounts in the credit side. This number plus this number plus this number plus this number plus this number. So you will see that the total is 3875. Okay, now you have two numbers. Here 8270, here 3875. So you choose the highest number. So the highest number in this sample question is 8270. So when you see the highest number, you put the highest number in the total. In the total of the account, in both the debit and credit side. So 8270. Here you also write 8270. Okay, now this number is lower. So when you see the number is lower in the here in this sample question, the lower number is in the credit side. So you calculate the difference between this number and this number. So you calculate the difference. So to calculate the difference, you this number minus this number. So if you use your calculator, the difference is 4,395. This is the difference between this number and this number. So this is the ending balance for the account cash. Okay, so when you get this number, you write the date is the last day in this month or in a year. So now the last day in this question is the 31st of December. So this is the ending balance of account cash. Ending balance of account cash for this business. So the logic is like this. For the account cash, debit cash means cash goes in or cash increase. See here, total cash increase during the month is 8270 for this business. And credit cash means cash decrease or cash goes out. So here in this sample question, the total cash goes out is 3,875. So what is the balance of the cash left for the business or in the business? The balance of cash left is 4,395. Cash goes in 8,270. Cash goes out 3,875. The balance of cash left at the end of the month is 4,395. That is the way to do it. Okay, let's see. So you have to do the same calculation for every account to calculate the balance of the account at the end of the month. So now we do the capital account. So the capital account, let's remember I have told you the first thing to do is you have to calculate the total in the debit side and the total in the credit side. So now see, the total in the debit side is 0. The total in the credit side is 8,500. 8,500. So which one is the highest or the higher? The higher number is the amount in the credit side. So you write the higher number on both sides of the account. So the higher number is 8,500. And so you have to write the same number here, 8,500. So what is the difference between this number and this number? The difference is 8,500. So you write the balance. The ending balance for the capital is, the ending balance for the capital account is the difference between this amount and this amount. So the difference is 8,500. Okay, now this is straightforward. See here, same thing. The equipment. Okay. The highest number, what is the total in the debit side? The total in the debit side is 5,800. The total in the credit side is 0. So which one is higher? The highest number is here. So you put the highest number, 5,800. 5,800. So here it is 0. 0, the difference between 0 and this one is this one, 5,800. So 5,800 is the ending balance. Just 31st of December of January, the ending balance is 5,800. Okay, I will do it quickly. So now here the balance is 500. The ending balance at the 31st of December is 500. Supplies 350. Okay, now see here. Okay, now I will show you again how to calculate the ending balance for account payable. First you have to calculate the total in the debit side and the credit side. The total in the debit side is 200. The total in the credit side is 350. Which one is higher? This side is higher, so you use this amount. You put 350 here and 350 here. So how to what is the difference between 200 and 350? The difference is 150. The difference means this one minus this one. You will get this one. So the difference is 150. This 150 is the ending balance for the account payable at the 31st of January. Okay, so that's the way. So drawing here 600. So you put here also 600. The difference is 600. So this 600 is the ending balance. Okay, revenue. If you add all these numbers, the total revenue is equal to 3290. 3290. So the total here should be 3290. So 31st of December, the ending balance is 3290. Okay, 3290. Okay, account receivable. See here, receivable. So you like I said earlier, you choose the highest number. So the highest number is 70. So you have to put also 70 here. So this one is the lower number. What is the difference between this one and this one? The difference is 20. The 20 is the ending balance of account receivable. Okay, now the last one is the utilities expense. So there is only one number, 275. This here you have to make it also 275. So you know the difference is the ending balance. Ending balance is 275. Okay, this is the way to do the ledger. Okay, so I will show again. The process is you have to transfer all the journal entries into the ledger. So I have you have seen how to transfer the journal entry into the ledger. The ledger contains many tax accounts, so you have to transfer one by one. So you have to transfer all the accounts in the you have to transfer all the entries in the general journal into the accounts in the ledger. So cash account, you have transferred all entries. After you have transferred all the entries, see, you have transferred all the entries, you have to calculate the ending balance of each account at the end of the month or at the end of the year. In this sample question, at the end of the month of January. So now you can see that the ending balance for cash is 4395. For account capital, the balance is 8,500. Sorry. Yes, 8,500. Account equipment, the balance is 5,800. Account rent expense, the balance is 500. Supplies 350. Account payable 150. Drawing account 600. Revenue account, the balance is 3290. Account receivable has a balance of 20. Utilities account has a balance of 275. Very important. You have to know how to transfer all the journal entries into the ledger, and you have to know how to calculate the balance for each account. Thank you very much. You can communicate with me in the comment section. Okay, bye bye.